The one area that we're going to drill down on today is 401k loans and what that can do over the course of someone's career. So we're going to start out walking through and comparing two different scenarios. The first scenario is without the 401k participant taking a loan. So they work between ages 25 and 65. Their starting salary is $30,000 a year, increases 2.5% each year. And it's invested in a 60-40 mix, so 60% stocks, 40% bonds. Without a loan and 5% salary contributions and a 5% employer match between ages 25 and 65, their ending balance is $1,324,500. So take all of that same information. The only difference is a couple of differences. The first is a loan taken out at age 32. For $10,000, it's paid back over 4 years with a 7.5% interest rate. Contributions continue after the loan is paid back until age 50, when another $10,000 loan is taken out with the same parameters, 4 years for it to be paid off, 7.5% interest rate. Contributions continue from 55 to 61 when a $10,000 withdrawal is taken out and not paid back. The ending balance is $937,000, $937,100. So that almost $400,000 less, but you're only taking out two $10,000 loans and a $10,000 withdrawal. So two different paths there, but that just goes to show what the effects of a 401k loan can be.
And when JP Morgan ran the math on this, they showed that when you take out a 401k loan and you pay back the interest, you do get some of that interest, but what you miss is the opportunity cost, not having that money invested in the market while you are taking the loan out and paying it back. You miss a lot.
Yeah, I think one of the suggestions was that you continue to make contributions on top of your paying back the loan, but that means that that might mess up your day-to-day cash flow or month-to-month cash flow even more. So obviously, if you can keep the contributions going in, then that's going to leave you in a better position. But yeah, I think the numbers jumped off the page to me because it's like $30,000 that you took out, but the difference is pretty substantial there. So I think the point being is that people, 401k participants, people that are just getting started, working in their careers, or anyone really needs to be able to cover emergency expenses. They need to have that cushion of savings at the bank so you don't have to dip into a 401k or another investment or retirement account to be able to pay off the unexpected expenses that it's difficult to plan for, but we know that they will arise 1 or 2 times per year. So yeah, it just speaks to the importance of that emergency fund.
Probably better to have more cash at the bank and less invested if it means you can stay the course with the investments. And staying the course means like risk tolerance, of course, being comfortable during market downturns, which are an inevitability. They happen every year in varying forms. But also, like we're talking about here, just unexpected expenses. I don't think you want to be in a position to be a forced seller for either of those reasons, in terms of because you can't stomach it or because you just need the money for something else. So, yeah, maybe it seems counterintuitive to have less money or lower contributions going in, but you can always, maybe it's a little more difficult with the 401k, but you can always contribute on a recurring basis at a lower total and send in one-time contributions. If we're talking about a brokerage or an IRA or something like that, or even a 401k, you could reach the end of the year and work with payroll to bulk up your contributions at the end of the year when you know more about your cash flow and the unexpected things that you didn't know were going to happen over the course of the year. It does leave some of it to chance. You want to automate it, because if you're not automating, then maybe it doesn't even happen. You got to weigh the pros cons of that, but I think you want to right size it is the bottom line.
I think more to what Brendan said is the common themes that we hear, the people taking loans from their 401k are to fill a gap that they've got in their personal finances. You're not really You may be taking a lump sum, in this case, $10,000 was the example, to take money out of your 401k, but you're really not solving the problem. In many cases, you're taking a loan out of a 401k to get rid of some credit card debt or some other situation. You haven't really fixed the problem because you're just transferring one loan for another loan. And it's hard to get ahead of things when you're scrambling all the time to finish off one loan and you have to take out another loan to finish the other loan. It doesn't really make sense.
Yeah, I think maybe something to consider with that is when you pay off the loan, not necessarily just going back to whatever in this situation it was 5% contributions to get the 5% employer match as well. Maybe you do 2% contributions or something like that, or do no contributions at all for a couple months after you're done paying the loan, and then use that extra cash flow to build up the emergency savings account. I know it's, especially after paying off a loan, you probably just want to get back into it and restart your contributions. But yeah, I think, like you said, you don't want to be in another situation a couple months down the road or a year or two down the road and need to take another loan out. So just to share a couple more numbers from JP Morgan's study that they did, nine out of 10 employees experience a significant spending spike over a period of 12 months. So they defined a spending spike as 25% more than their baseline spending over 12 months. So if we just make up an imaginary budget here, if your expenses are $8,000 a month, that's $96,000 a year. So 90% of people experience a year where spending is 25% higher due to that unexpected spike. So with that budget, people will need to be able to absorb a $24,000 shock. So that's just 25% of the annual budget. You need to have that in savings. You can bank on an unexpected cost popping up out of nowhere that you need to be prepared for and insulated against pretty much annually at this point.
And it's something that I've heard for decades now, that people want to really try and stick the landing or fine tune exactly how their money is invested, how it's situated. They don't want to, there's a lot of people that just don't like the idea of money sitting at the bank, not doing something. Doing something, if it's there as your emergency fund, your reserve, that serves an important purpose. And you need to have, you can't draw that down to zero. You've just got to be prepared for the unexpected.
Top 3 reasons for taking 401k loans, according to JP Morgan: pay off credit card debt, cover medical expenses, and cover another emergency expense. So just to share some ideas of why people are taking these kinds of loans.
I think it's interesting that the percentage that represents a spike in this study is 25%, because I know that a common way that we try to stress test retirement income plans while we're doing them for folks is by taking their expenses that we hope we've collaborated with them to intentionally get correct in terms of what we're projecting their needs to be. But then the stress test is often 25% boost to those expenses. And so just to that point of, I think that's a good margin for error to bake into the plan. And even if it seems unlikely, I think that these numbers would suggest it's probably not all that unlikely. And it'll let you know if your income plan works well at the base level and breaks at 125%, then it speaks to just the fragility of things. And that can probably guide you in terms of what you want to do moving forward, or what kind of decisions you want to make with things like spending, or how flexible you might need to be if we enter a poor market environment, that kind of thing.
Yeah, I think the big takeaways for me when we hear people talking about or considering taking a 401k loan is that they're not making ends meet for whatever reason, but they're basically trying to fix a hole or patch something, but they're going to be borrowing money to do it. Yes, there's always the argument that you're going to be paying yourself back, but you miss out on all of that long-term compounding when you basically stop that by reversing course and taking money out of a retirement plan. There's also the risk, and they didn't really get into it, but in the second example where people took money out and they just never paid it back, if you take money out in the structure of a 401k loan and you don't pay it back, or you don't make, I think it's 2 payments in most cases, that is considered a default. And if you're under the age of 59 and a half, not only is it taxable income, but you're now going to have a penalty on top of it. You're just compounding one money mistake after another. This could all be avoided if you had money outside the plan sitting in a reserve account.
Yeah, I think for retirees too, it's equally as important as someone who is in their working years, especially if your main bucket of income is a tax deferred savings account like a 401k or an IRA. Because if you need to take dollars, in this case, if the person's retired, it would just be a distribution, not a loan. But every dollar that you take out of there is going to be taxable income. So you're going to need to take out more than you planned on so you can withhold the correct amount of tax.
Yeah, whatever you
But
need, you should just assume it's whatever you need plus your marginal tax rate at the set and stay level. So it can compound pretty quickly. On one hand, you probably don't want to take money from a retirement account before you need to. But yeah, like the idea of on-the-plan expenses being paid for by further retirement account distributions can get complicated from a tax perspective too. And if you're not adjusting the withholdings on the go, you could end up under withheld there, and he's got a tax issue. All the same as what we're talking about with maybe unintended 401k loans turning into distributions. So it can get messy.
On a somewhat related note, I'll just throw it out to both of you guys. How often do we see people getting close to retirement and most of their assets are in a retirement plan? They don't really have a whole lot of cash. What percentage would you say people are showing up with those kind of looks?
75, 80%. I think it's more common than not. I think it speaks to the nuance of investment planning, of retirement planning, because I think it's pretty common knowledge for people to contribute as much as they can to their workplace plan and plow as much money into their plan. And the earlier you start, the more time you give yourself for that money to compound. And that is true. But you can also, especially as you're approaching retirement, you can, maybe you take a peek under the hood and see if it's worth it to continue to contribute to a 401k or tax deferred investment account, or you can save in a regular brokerage account, or you can just build up your cash cushion at the bank and then use that to live off of in the first year or 2 or 3 of retirement.
Yeah, I think it's just the 401k is the default. And so a lot of people are doing that, and I think it's a good thing. But sometimes it seems like the 401k, especially if you're in a position where you're hitting the max like pretty comfortably or easily with your income towards the end of your career, it almost seems like if you've checked the box, then you're not considering other ways to save that could help from a tax diversification standpoint. So if you're hitting your 401k max at 10 or 15% of your salary, you should be thinking of ways throughout the year to supplement that with an additional savings plan into a different sort of a tax bucket, even like Kay said, even if it's just something like a brokerage account or building a sufficient emergency reserve. Both would be ideal. They give you like some flexibility as you get to the distribution phase. But I guess you don't want to discourage people from doing something like contributing to their 401k. It's a definite positive and it's better than doing nothing, but there may be more to do. And I think that sometimes gets just lost in translation to folks or set aside. And maybe that's why we see so many reach the retirement phase of their lives with just a 401k and very little elsewhere in terms of
checking account.
accounts. Yeah, checking out 401k. It really does limit your options when you're talking about managing taxes and retirement income distribution.
It doesn't have to be an on-off switch too. It can be a gradual taper, or you can just lessen the amount that you're contributing to a 401k. It doesn't have to be black and white. It usually never is.
Yeah. It's interesting how we have conversations with folks in their 30s and 40s, and they need to take out a 401k loan to rebalance the balance sheet. And as Casey alluded to a few minutes ago, sometimes we suggest, hey, maybe you downshift a little on how much you're actually contributing to the plan, or something really drastic. And financial planners who are listening to this, just cover your ears. But maybe for a year or so, you just suspend making contributions into the plan and put that money into a savings account.
All right. So like maybe
It's very drastic.
Maybe that's an answer, but also if you're in such cash flow dire straits, like we got to look at, are there any other ways to reduce? Like I can fully appreciate if somebody is truly in a position where their income is just not keeping up and everything that they're spending money on is a necessity. But when you're in that situation, I think that's like the easy answer. And it does solve the problem and it should be part of the conversation. It's creative and probably not something that's being thought of, but it's definitely not the best solution.
No, definitely not.
It may be the cleanest shirt in the dirty hamper thing in terms of, I guess if you've exhausted all other options or ways that you could fix your cash flow, then obviously if that's the only thing you can do, then sure, don't contribute to your 401k and then just take the money right back out. That's silly.
Right. Yeah.
But,
it's drastic.
Yeah.
Yeah. It also breaks up the habit. Like I think Bren, you mentioned before, one of the main benefits of the 401k is it's a default. You set and forget. You never even see that money. It just gets zapped automatically from your paycheck into the investment account.
Yeah.
If you break that up, the chances of starting again it depends on the person, but I feel like they're definitely less likely to restart.
A lot harder to go back.
Exactly. Yeah. So you want to keep the momentum up if you can, but you got to explore every option and everything's got to be thrown on the table. Emergency fund, it's the basics, but there's a lot of thought that should be put into it.